what happens is that this will be the entry to recognize collection of $1,000 plus the $60 of interest. Okay, upper part of this table really is very similar to what I wrote there on the whiteboard. We start from note inception, meaning the creation of the note, September 30th. And when it reaches December 31st, since we need to do 2014 statements, we recognize 3 months of interest. So the first part, 3 months, was the journal entry that we made here. Okay, this is the entry when it gets to September 30th, 2015, when we want to collect the total amount of $1,000 principal amount plus $60 of interest. This is the entry that we would journalize. Okay, so if you take a closer look here, notes receivable relates to just the principal amount, the amount that we borrowed to Holland customer. Interest receivable here, we reverse this, reduce this, because we're collecting the $15 by cash now. And this 15 relates to the previous entry here. Okay, remember all the receivables later when we collect by cash, we need to reduce receivables, just like accounts receivables collected by cash. Notes receivables here, we're collecting it by cash. Okay, so together with interest receivable, the 3 months that we recognized earlier, now we are collecting by cash this $15. Also, we're also collecting $45, which relates to this period's interest. Altogether, the total interest amount is $60, but because this note crosses into 2 accounting periods, we recognize $15 as interest revenue in 2014, $45 interest revenue in 2015. But both amount will be collecting plus principal amount together in 2015 when the note matures. Basically when it reaches the due date of the note. Okay, so for the case that we just talked about, also involves 3 journal entry. You will definitely have one journal entry that happens here, September 30th, when you borrow money to that customer. So that journal entry is the note inception entry. You will have notes receivables, since you borrow money to others, and then you reduce cash $1,000. This is the first entry that happens September 30th. Since this is a 1-year note, when it reaches the end of this year, December 31st, we want to make an adjustment for interest that has accumulated up to this point. So when it reaches December 31st, you have an interest receivable entry. Just recognizing the part of interest that has accumulated for 2014, and also interest revenue. So that will be just $15, the entry that we did earlier, this. Okay, that's the second entry on interest. And the third entry would be this entry. So there are 3 time points: creation of the entry, creation of the notes, and then at the end when we want to recognize the part of interest that accrued, and also September when it reaches the maturity date, the due date for the note. Then we make this journal entry here. So this journal entry means that we're now collecting the total amount of cash, $1,000 plus $60 of interest, and then reversing notes receivable, because now we're collecting it by cash, so we reduce notes receivable $1,000. We also reduce interest receivable that we recognized last year end, the $15, and then also interest revenue that is considered this year's interest revenue for 9 months. $45. Okay, this is also the most complicated case for notes, if it's a note that carries on to 2 accounting periods. Generally speaking, you only have this journal entry, creation of the note, and then an entry on collection of the note. If it all falls under one accounting period, there will only be 2 entries. You don't have to make adjustments at year end if it doesn't even reach year end. Meaning if it's a note that only has 2 months of time frame or 3 months, then you just have September creation of the note and possibly November collecting the cash. Just reversing this previous entry and adding interest, that's all. You only have this first one and the third one. But if a note carries on to second accounting period, when it crosses December 31st, since we're making statements here, we always want to adjust the part of interest that has accrued. Okay, so if we put together